When a 200-foot steel cylinder drops from the edge of space and sticks the landing perfectly on a small pad, it is a triumph of modern engineering. SpaceX built a revolutionary, reusable launch infrastructure and blanketed the globe with the Starlink network. That undeniable success fueled a frenzy when the company went public in June 2026. The initial public offering was a spectacle. Shares debuted at $135 and rocketed past $225 in a matter of days. But a company building incredible hardware does not automatically make for a sound financial investment. You have to separate the physics from the price tag. People love the idea of humanity expanding to the stars. That emotional bond with the mission effectively blinded the public to the deeply predatory financial mechanics hidden inside the stock offering. Let's start with the baseline math. Following the listing, the company hovered near a valuation of $2 trillion. To put that in perspective, the business reported a net loss of $4.9 billion in 2025. This chart compares enterprise value to sales, showing just how disconnected that price is. The red bar is SpaceX, trading at a 104 times its trailing revenue. For context, massive, highly profitable tech giants like Meta and Nvidia trade at a tiny fraction of that multiple. Paying over 100 times sales for an enterprise currently losing billions of dollars defies all traditional market logic. It tells us that this deal was not structured to reward the people buying the stock today. Instead, it was engineered to use ordinary retirement accounts to cash out early insiders. And the trap is designed to capture your money whether you actively chose to buy the stock or not. To even begin justifying a $2 trillion price tag, the company's own models require it to hit roughly $320 billion in artificial intelligence revenue and nearly $500 billion overall by the year 2030. That requires a growth curve rarely seen in market history. This free cash flow chart illustrates a staggering cost. The blue line tracks cumulative free cash flow plunging to negative $201 billion by 2029. The dotted gold line reveals the immediate problem. The $75 billion raised in the IPO gets completely exhausted during 2027. A company burning cash at that rate will return to the public markets to survive. They will need to issue millions of new shares, heavily diluting the stake of anyone who bought in at the IPO. Retail investors buying at the absolute peak are footing the bill for an impossibly expensive roadmap, absorbing the downside risk while their ownership percentage shrinks. The financial drain is only part of the trap. The legal structure guarantees public buyers have absolutely no say in how their money is spent. Because insider shares carry 10 votes each, public investors might hold 42% of the equity, but insiders retain 85% of the voting power. If those insiders mismanage the business, the public has zero leverage. The corporate charter enforces mandatory arbitration, completely waives class action rights, and claims exemptions that eliminate the requirement for an independent board of directors. Look at this timeline of related party transactions. Over the past decade, capital has consistently shifted back and forth between the CEO's various private entities, effectively routing money and hardware between SpaceX, xAI, and X. Purchasing a share of SpaceX does not buy you a voice in the boardroom. It simply grants the CEO unlimited power to funnel your capital into a private ecosystem, free from any external oversight. To make this pricing hold, the IPO is structured with an extraordinarily low free float, meaning the percentage of total shares actually available for the public to trade. By releasing only 4 to 5% of the company to the market, they artificially choked supply, driving the initial price sky high. Then, NASDAQ bent its own rules. They utilized a fast-track inclusion rule, allowing the stock to bypass standard waiting periods and enter the NASDAQ 100 index within 15 days of listing. As this document details, that exposes an estimated $1.4 trillion in passive funds to mandatory purchasing. Every index fund, 401k, and pension tracking the NASDAQ 100 is mechanically forced to buy the stock to match the index weighting. Trillions of dollars are blindly funneled into an artificially scarce, heavily inflated asset. When you combine a microscopic public float with forced index purchasing, the market stops functioning as a pricing mechanism. It becomes a mechanical wealth transfer, weaponizing ordinary retirement savings to cash out insiders. The fallout from this artificial inflation was immediate. Just a week after the initial peak, the stock plummeted right back down to $156. As this chart highlights, that single drop erased roughly $600 billion in market value in a matter of days. There are smarter ways to capture the growth of the space economy. Secondary ecosystem companies, the suppliers and infrastructure builders supporting orbital launches, offer exposure to the exact same industry tailwinds without the massive overvaluation or toxic governance structures. This IPO serves as a stark warning. When private megacap companies wait this long to enter the public markets, they aren't looking for partners to share the upside. They are looking for an exit. No matter how advanced the rockets are, financial gravity eventually takes over, and the long-held assumption that passive index funds will protect you from predatory market mechanics has finally come crashing down.